gotta enjoy what you made.
Hey, thought she was a hooper nigga, way she tried to ball me. Thought she was a cashier, the way she tried to ball me. Thought she was a hooper nigga, way she tried to ball me.
Hey.
Thought she was a hooper nigga, way she tried to ball me. Thought she was a cashier, the way she tried to charge me. Thought she was a family nigga, way she tried to maul me. Thought she was a lion nigga, way she tried to maul me. Thought she was a hooper nigga, way she tried to ball me. Thought she was a cashier, the way she tried to charge me. Thought she was a lion nigga, way she tried to maul me. Thought you wasn't a lion nigga, you know that you lying nigga.
Hey, turn me up. Shoot, we still working on the music and I'm still having fun with it. That's the most important thing for me. As long as I'm having fun with it, it's no rush for me to drop music. I don't care how long it takes for me to perfect my art, to work on my craft, and to have fun. Shoot, I could not drop another song forever and I'm still having fun. I'm still be happy and blessed. Shoot. But we back with another episode. If you haven't, subscribe to the channel. Like this video because you're missing out on a lot of educational, inspirational, and motivational information. Please tell a friend to tell a friend to tell a family member to tell a friend. And we will get these things going. But this week I'm talking about crypto like I promised last week. I'm going to talk about the difference between proof of work and proof of stake and why that's even important in you investing into crypto, right? So before we get into that, I do want to talk about what happened in the market today. Of course, the market had a down day. The NASDAQ was down like 100 something points. It was down like 180 something points, something like that. SPX was down. I don't really care about the Dow Jones, but yeah, the three major indexes were down. I checked volume, and surprisingly, volume was high. Volume wasn't low. Usually, that's not a good sign when you see that volume is high and the market is down. Usually, you want the market to be down when volume is low, because at that point, stocks and the market will be down just due to a lack of buying. It's more selling than buying going on. But now it was a lot of volume, was showing you like, all right, it was a lot of selling and a lot of buying going on. So what's going on? Now, obviously, there were more sellers because the market was down. But again, usually you want down days to have less volume just for there to show that there was a lack of buying today. There's nothing really going on, but I'm not scared of nothing. You shouldn't be scared of what's going on. Again, last week I did talk about if there might be a recession. I'm watching those yields. Do got to watch those and see what those ended at today too. But Apple, if you haven't noticed, like Apple is the best stock in the stock market, hands down. Apple, Microsoft, but Apple is still like the best stock in the market. The amount of institutional money that's in there, it hit another 52-week high today and it came back down, closing in on that 3 trillion market cap. Like, if you're not in Apple, then I don't know what else to tell you. So you had that went in, and again, I do need to check the treasury yields. I don't know why I didn't check that before, but yeah, I do next week. I do want to cover technicals because I think the market went down purely because of technicals, and I'll explain what I meant by that. Let me open up this tab. Let me open up the SPX, and again, you're not gonna be able to see it this week, but next week I'm gonna chart and show you what I'm talking about. But I'm gonna go over major like support and resistance levels and what does that mean, why those levels are important. But basically, the SPX major resistant level, also known as the S&P 500, it went down today because it hit a major ceiling, also known as resistance. So every time it hits that ceiling, you think of it like a price ceiling. Every time it hits that ceiling, it comes back down, right? So every time it hits a floor, it hits the floor and bounces back up. So floor is kind of known as like support. Ceilings are kind of known as resistance, right? So this resistance was a key level, 47.16 to be exact, because the SPX hit that level on November 5th. It hit that level on November 8th. It hit that level on November 16th. It hit that level on November 19th. And it got close to that level on December 10th. So that's 1, 2, 3, 4, about 4 or 5 times that the SPX has hit that ceiling, that exact price, 47.16, and came back down. That exact price came back down 4 or 5 times within what, a month? Within a month and some days, 4 to 5 times it hit that price level and came back down. That's what we call the major resistance or ceiling area. And again, I'll show you that next week, and I'll go over the definition of what it means psychologically, why those levels are important. But I personally think that's why the market went down today. It kind of hit that level last Friday when it closed. It was at that level, and now it actually bounced back to a major support level. The next support level would be 4673, around there, and right now it's at 4668. So it's just around that support level. So I personally think the market will have a bounce back tomorrow because it is at a major support level. But again, we'll see. Let's see if technicals work. I think that the market went down yesterday purely because of technicals. Now, if it could break that ceiling that it hit 4 or 5 times, then that's when you know the market would be on the bullish breakout. If it could, like 2 or 3% from that ceiling, woo, we're gonna go on a rally. But if it can't, it's gonna continue to struggle. And again, this major support level is at this level right now, 4673. It's a little bit below that level on the close. So I think the market will have a nice bounce back tomorrow. So we're going to see how that works out. Hopefully it does have a bounce back tomorrow. Everybody keeps saying they're waiting on the Santa rally in the market. I'm curious to see if that's going to happen. So, man, 2021 is almost over. 2022 is approaching. It's crazy. It's crazy of how much I've accomplished this year. You know, I started my investing journey. Really, shoot, I hopped into the stock market and, you know, and really started doing things in March, my long-term investment portfolio in March. But the amount of growth that I've been seeing and the amount of growth that I've seen, how much information I've learned about the market, man, I'm just happy to be where I'm at, and I'm blessed. All glory to God, of course. I couldn't do none of this without the man above doing the work behind the scenes. So, you know, I can't wait to do the year-end market. I'm thinking about the market. The year-end video recap to see, you know, what we accomplished this year, set some goals for next year, and keep it moving. Keep it moving. You know, I'm 2 years away from retirement, speaking it into existence right now. I'm 23. I'm going to be retired by the time I'm 25. I'm recording this on Monday, December 13th at 3:25 p.m. I'm 23 years old. I'm going to be retired by the time I'm 25. Best believe me. Especially if this stock market crash is coming. Oh, yeah. I'm going to see some major opportunities. I'm already mapping out my entry points for a lot of these stocks. Google, I'm going to be a shareholder soon. So I'm going to need you to do that stock split. Apple, of course, I'm going to load up on some more options. Microsoft, I'm loading up on some more options. Shoot, y'all better stop playing with me. But we're going to get into this cryptocurrency. First thing I want to talk about, I'm going to go over what it is to be proof of work versus proof of stake, right? So if you don't know what cryptocurrency is, let me just begin there. So cryptocurrency is basically a peer-to-peer transaction-based exchange, or not exchange, but you know, you can send money from one person to another within the matter of minutes, no matter where they are in the world, unless they country ban crypto. But even then, sometimes you can still get it. So you can send money peer-to-peer, and there's no bank or financial institution that's backing it. So there's no bank that's approving the transactions. There's no bank that's making sure the transactions are valid. And there's no banks that's backing cryptocurrency or the transactions that's happening. That's why they call it decentralized finance, because there's no one institution, there's no one government, there's no one person that controls the cryptocurrency. And again, every cryptocurrency is going to be proof of work, proof of stake. And I'll get into that. But that's what cryptocurrency is. So the reason why it's become so popular is because no one entity controls it. They call it the people's currency, right? So how is the cryptocurrency, you know, validated then, since there's no bank backing it? Well, first you have cryptocurrency that runs on software programs, right? Or software networks, I should say. And the software networks basically, they have two major responsibilities, right? And I do want to note that these software networks are open source platforms, which means that anybody can access them. You don't have to be an owner of a bank. You don't have to work in the financial industry. You don't have to be a teacher. You don't have to be a stock investor. None of that. They're open source platforms to where anybody can get them, right? So that's, again, another benefit to decentralized finance, to cryptocurrency, is that these open source networks, anybody can go access these. So if you wanted to mint Bitcoin, if you wanted to mine Bitcoin, if you wanted to stake Ethereum, anybody could go access these apps. So that's what it means to be decentralized and have open source networks, open source platforms. So again, cryptocurrency runs on these software networks, and these networks have two functions. The first function is to process all transactions that happen on the blockchain, right? So every transaction that's occurring, if I send money to somebody, if I send Bitcoin to my friend, the networks have to process that transaction. That's the job. The second responsibility after it processes the transaction is to maintain the database and store those transactions onto blocks or blockchains, what they call them. That's why the name comes from blockchains. So all those informations are basically like stored on virtual ledgers known as the blockchain. Every single transaction that's ever happened on the Bitcoin blockchain network is always going to be stored there. So that's the second responsibility of the network. The network that the crypto runs on is to store the transactions that it just previously processed, and to keep it on there forever, to make sure there's always going to be a receipt of that transaction on that blockchain. So the blockchain is basically just like virtual ledgers, and keeping proof of everything that's been happening onto the blockchain, right? So those are the two main functions of the software networks that crypto runs on. Now let's get into proof of work versus proof of stake. So any crypto that's out there, whether it's Solana, whether it's Bitcoin, whether it's Ethereum, Cardano, Tether, Luna, it's either going to be proof of work or proof of stake, right? So proof of work, let me just start off by the utilities and equipment that you need. If you wanted to mine Bitcoin or any other crypto that's proof of work, you're going to need a ton of computing power. You're going to need a ton of electricity, and you're going to have to keep it running all day and every day. Why? Because this is a way that cryptocurrencies validate the network, a way to keep the network honest. One way is through proof of work. So when a transaction happens, the blockchain just generates a random sequence of numbers, right? A random sequence of numbers. And the miner's job on proof of work networks is to solve that mathematical equation that the blockchain just dished out. So the blockchain is coming up with a random sequence of numbers that's very, very difficult to solve. So the only way that you're going to have an advantage in proof of work is to have a ton of computing power, a ton of RAM, a ton of memory, a ton of electricity, because the faster your computer is working, the more equations that it could run through to try to get that equation right, to try to solve the problem. And once the problem is solved by a miner, they're receiving rewards in Bitcoin that's freshly minted, right? So that's the rewards for minting or proof of work incentives for miners who mine proof of work cryptos like Bitcoin. The reason why they do that, they want to help validate the transaction, solve the mathematical equation, do the algorithms, and then once they solve the equation, then they'll receive freshly minted Bitcoin. Now, again, it's very, very disadvantageous for proof of work cryptos because they use a ton of electricity. You need a lot of computing power, and it's kind of like a lottery for the ones who's going to solve it. You don't really need any talent. You just have to have a ton of computing power to try to solve the equation faster than anybody else can. And again, the blockchain basically just chooses a random person that's like, all right, you solve it, like, random miners. So that's what proof of work basically is. It's kind of like you got to set up your own computer-based office, a lot of electricity generating in there. You're probably going to pay a lot of money for the electricity bill if you do mine. And if you don't end up solving any mathematical equations and not getting any Bitcoin, then it's really, you're going to just be in debt paying all them electricity bills. But that's basically what proof of work is, right? So the difference between that and proof of stake is called proof of stake because instead of doing that, you don't need any major electricity or major computing power. All you have to do is stake the coins that you have. So if you wanted to help validate the Ethereum network or the Ethereum blockchain, what you're going to do is stake the coins that you hold. So if you hold 0.5 Ethereum, you can stake 0.5 Ethereum, run that onto, you can stake in a pool, or you can stake solo if you have enough Ethereum, and or you could be a node validator and stake as much coins as you have. And once you do that, you're locking your Ethereum coins onto the blockchain, and you're helping validate all transactions that's happening within the Ethereum blockchain. Again, you don't need any major computing power for this. And the incentives are for this, there's really no reason to mess up the network. Now let me go back to proof of work real quick because I did forget to mention this. There's a thing called tragedy or commons, right? And that's going to be a future point in time where there's less miners in the Bitcoin in the Bitcoin network, because again, Bitcoin has a max supply. There's only 21 million Bitcoins that's ever going to be out there. 21 million. There's not going to be any more than that. And right now it's a little less than 19 million. So it's about 2 million away from being all the Bitcoin that's ever out there. So once that hits the max supply of 21 million, then miners are really not going to have any incentives to mine Bitcoin because the rewards is not there. They're only going to get rewarded the transaction fees that's happening on the transactions. They're not going to get rewarded any new freshly minted Bitcoin because there's no new Bitcoin to mint. There's only 21 million ever that's going to be out there. 21 million Bitcoins that's ever going to be out there, right? So a lot of people are saying that once that max supply is hit by Bitcoin, the miners are going to start committing fraudulent activities onto the network. They're going to start messing up, previously like ledgers that were validated. They're going to start making them, fraudulent. And, I don't really understand how that would happen, but, I just like to hear both sides of what could go on. I like to hear the bear case and the bull case of all equities or cryptocurrencies that I'm invested into. So that might be something to look out for. Once that max supply is hit of Bitcoin, 21 million, if the miners start doing some fishy things, then, that's a negative also to proof of work. Back to proof of stake. If somebody wanted that much control of the network, you would have to hold that much of the coins, right? So if you wanted to control 51% of Ethereum's network, first you would have to purchase 51% of Ethereum coins out there, which is kind of costly. So if you wanted all the coins, 51% of them, you're going to have to spend a lot of money. Plus, once you have that 51% of Ethereum coins that's out there, it wouldn't really benefit you to go and mess up the network because you hold 51% of the coins. So if you go and start doing some fraudulent activity on the network and bring down the value of the coins, well, the value of your 51% that you hold, the 51% of Ethereum is going to go down, right? So there's really incentives to do good and only good for proof of stake. Well, proof of work is kind of like, all right, once those miners hit that max supply, then they're going to start trying to mess up the network and trying to steal people Bitcoin, try to go back in a lot of processes that they find and start stealing try to hack into people's wallet and stuff. Who knows? But I just know that with proof of stake is more beneficial. You don't have to use a lot of energy like you do with proof of work. All you got to do is hold the coins, stake them, and you're good, right? But again, what cryptocurrency or risk in general is that you're basically saying like, it's okay. I know somebody can steal my coins if I hold them on the exchange, if I lock it into the blockchain. It's always a possibility that somebody can steal your coins unless you actually have them in a physical wallet. And even then, I'm pretty sure they can still get into that. So that's the risk that you hold with cryptocurrency. Of course, you should know that before you invest into it, the risk and the rewards, right? That's why the rewards are so high, because the risk is so high. Like, there's no number that you can call if your coins get stolen from an exchange. If your coins get lost, there's nobody you can call to come in and save you, right? So once those coins are gone, they gone. And that's a risk that you should be aware of when you're investing into cryptocurrency, if you're looking to stake, if you're looking to mine. And there's this big debate going on about whether Bitcoin is going to transition into proof of stake. And, a lot of people are saying they should. And then again, another side is saying that it's too late. It'll already be too complicated of how far Bitcoin came, how far it came, how far it is. It'll be too complicated to convert over into proof of stake. But Ethereum actually is, I think they made a great decision by converting over from proof of work to proof of stake, which is not 100% finished yet. So they're still in the process of doing that. I know that it's a fun process I'm enjoying because I do have Ethereum staked. I have some staked on Rocket Pool and I have some staked on Stakewise. And I like Stakewise. I like Stakewise so far better than Rocket Pool. I love proof of stake coins. Like, if you a proof of stake crypto, you automatically get my attention. I stake Luna, have Luna staked, and the rewards are crazy. Like, I don't think y'all understand of how far y'all can really take this staking, because this could just be literally another source of passive income. another source of passive income. And I'm not gonna keep like just giving everything out there because I know a lot of y'all not gonna take action anyway. But it's something that just blew my mind that like when I came across it, and I'm still researching every day of how proof of staking works to see if I could find new information about it. Like staking solo, you have to if you want to stake solo on StakeWise, you got to hold 32 Ethereum. Like, I'm gonna be there one day. I'm definitely gonna be there one day. But I just wanted to go over the proof of work versus proof of stake because when you invest into the cryptos, if you are investing into cryptos, I feel like that's important to look at, especially if you want to earn some rewards or some extra interest on your crypto just for holding it, just for staking it. You can. You don't need to have anything special. You don't need to have computing power. You don't need to have electricity if it is proof of stake. So I just wanted to go over that. Next week, I'm going to hop on my computer, show you some charts, show you some support and resistance areas. What does it mean? Why does that psychologically matter? Why those levels matter? But, it's been a great year. Wrapping it up, getting 2021 wrapped up. Got some things I need to take care of, but other than that, I appreciate y'all watching. If you haven't subscribed again, please do. I hope you enjoyed this episode. If you liked it, give me a thumbs up on the video. Please share it. Don't forget to share. It's easy for you to share and be like, man, you should subscribe to my boy. Help me out. But I appreciate y'all watching. Hopefully y'all enjoyed it.